Imagine if I told you that the reason ChatGPT exists today has more to do with tax laws than brilliant coding. Or that the next breakthrough in artificial intelligence might not come from Silicon Valley genius, but from a government official adjusting depreciation schedules in Washington, D.C. Sound crazy? By the end of this video, you'll understand why tax policies are quietly shaping the entire future of artificial intelligence in ways that would shock most people. What's happening right now is a massive global chess game where countries are using their tax codes as weapons to attract AI companies, and the moves being made today will determine which nations dominate the technology that's reshaping our world. This isn't just about numbers on spreadsheets. This is about power, innovation, and trillions of dollars flowing between countries based on decisions made in boardrooms you've never heard of. Let's start with something that happened just last month that barely made headlines but changed everything. Ireland quietly adjusted their corporate tax structure for technology companies, and within weeks, 3 major AI startups announced they were relocating their European operations there. Microsoft immediately began expanding their Dublin AI Research Center. Google started hiring hundreds of machine learning engineers in Cork. This wasn't coincidence. This was tax policy working exactly as designed. Here's what most people don't realize about the AI industry. These companies burn through cash like wildfire. Training a single large language model can cost over $100 million. The electricity bills alone for running AI data centers exceed the GDP of small countries. When you're spending that kind of money, every percentage point of tax savings becomes massive. A company saving 5% on taxes can reinvest that money into hiring dozens of top AI researchers or purchasing thousands of additional graphics processing units. But the tax influence goes deeper than just where companies locate their headquarters. Research and development tax credits are literally determining which AI technologies get developed and which ones never see the light of day. In the United States, companies can claim credits for up to 20% of qualified research expenses. This means the government is essentially subsidizing AI development, but only for certain types of projects that meet specific criteria. This creates a fascinating distortion in the market. Companies aren't just asking themselves what AI technology would be most beneficial for society or most profitable for their business. They're asking what AI projects will qualify for the biggest tax breaks. Natural language processing research might get prioritized over computer vision simply because it fits better into existing tax credit categories. Medical AI applications might receive more funding than entertainment. AI because healthcare research qualifies for additional incentives. The depreciation rules for AI hardware represent another massive influence that nobody talks about. When a company purchases millions of dollars worth of specialized AI chips, how quickly they can write off that expense dramatically affects their decision-making process. Countries with accelerated depreciation schedules for technology equipment are seeing AI companies flock to their borders. Meanwhile, nations with slower depreciation rules are watching their tech sectors stagnate. Singapore has mastered this game better than almost anyone. They offer immediate expensing for AI-related equipment purchases, meaning companies can deduct the full cost in year 1 instead of spreading it over multiple years. The result? Singapore has become an AI hub, despite having virtually no natural advantages for technology development. It's pure tax policy magic. The international tax competition for AI talent is even more intense than the competition for companies. Top AI researchers command salaries exceeding $500,000 annually, and the tax treatment of these wages varies dramatically between countries. Some nations offer special visa programs with preferential tax rates for AI specialists. Others provide tax-free housing allowances or research grants. Canada's Scientific Research and Experimental Development Program has attracted thousands of AI researchers who might otherwise have stayed in Silicon Valley. But here's where it gets really interesting. The tax policies designed to attract AI investment are creating unexpected consequences that even the policymakers didn't anticipate. When you make AI development artificially cheap through tax incentives, you accelerate the timeline for automation. Jobs that might have remained human-performed for another decade are suddenly becoming economically viable to automate because the AI development costs have been subsidized. Manufacturing regions that lobbied for AI tax incentives to attract high-tech investment are discovering that the AI companies they attracted are now automating away the very jobs those communities were hoping to create. It's a perfect example of being careful what you wish for in tax policy. The data privacy regulations intersecting with tax policy create another layer of complexity. Companies want to locate their AI operations in countries with favorable tax treatment, but they also need to comply with data protection laws. The European Union's strict privacy requirements conflict with some countries' tax advantages, forcing companies to make difficult trade-offs between tax savings and regulatory compliance. Some AI companies are splitting their operations specifically to optimize both tax efficiency and regulatory compliance. They'll keep their data processing in Europe to satisfy privacy laws while moving their research and development to tax-friendly jurisdictions. This geographic arbitrage is creating a new form of corporate structure that didn't exist before. AI became central to business operations. Transfer pricing rules are becoming crucial for multinational AI companies. When a company develops AI technology in one country, but licenses it to subsidiaries in other countries, how they price those internal transactions determines where the profits get taxed. Tax authorities worldwide are scrambling to understand how to value AI intellectual property. And the rules they create will shape global AI development for decades. The carbon tax implications of AI development represent an emerging battleground that most people haven't considered yet. AI training and operation consume enormous amounts of electricity. As more countries implement carbon taxes, the environmental cost of AI development becomes a significant financial factor. Countries with clean energy sources and no carbon taxes are positioning themselves as preferred destinations for energy-intensive AI operations. Looking toward the future, we're seeing the emergence of AI-specific tax policies that didn't exist 5 years ago. Some countries are considering special tax rates for AI-generated revenue. Others are debating whether AI systems should be treated as employees for tax purposes once they reach certain capability thresholds. These might sound like science fiction concepts, but they're being seriously discussed in tax policy circles today. The automation tax proposals gaining traction in several countries could fundamentally change AI economics. If companies have to pay taxes equivalent to the payroll taxes of displaced workers when they implement AI automation, the financial incentives for AI adoption shift dramatically. This could slow AI deployment in some sectors while accelerating it in others, where the productivity gains still justify the additional tax burden. International tax coordination on AI issues remains virtually non-existent, creating opportunities for regulatory arbitrage that smart companies and countries are already exploiting. The first nations to establish clear, favorable AI tax frameworks are attracting disproportionate investment and talent. Meanwhile, countries stuck in bureaucratic debates about AI taxation are watching their technology sectors migrate elsewhere. The venture capital funding for AI startups is increasingly influenced by tax considerations that founders often don't fully understand. Investors are steering money toward startups in jurisdictions with favorable tax treatment for technology investments. This means the next breakthrough AI application might emerge from an unexpected location, simply because the local tax environment supported early-stage development better than traditional tech hubs. What we're witnessing is the birth of a new form of international competition, where tax policy becomes the primary tool for technological supremacy. The countries that figure out how to use their tax codes most effectively to attract and nurture AI development will likely dominate the global economy for the next century. The implications extend far beyond technology companies and investors. Every worker, every industry, and every government will be affected by these tax policy decisions being made today. The pace of AI advancement, the types of AI applications that get developed, and the geographic distribution of AI benefits are all being determined right now in tax offices and legislative chambers around the world. This invisible hand of tax policy is shaping the future of human civilization through its influence on artificial intelligence development. Understanding these connections isn't just academic curiosity. It's essential knowledge for anyone who wants to understand where our world is heading and why certain AI developments are happening faster in some places than others. The next time you hear about a major AI breakthrough or see an AI company relocating to a new country, remember that behind the headlines about technological innovation, there's likely a tax policy story that explains the real driving forces at work. The future of AI isn't just being written in code, it's being written in tax law.